Okay, let's unpack this. You sent us a really great chunk of information from Kiso, Wiggin, and Warfield's Intermediate Accounting. It's all focused on investments. And our mission today, to give you the ultimate shortcut, basically a crystal clear, comprehensive, and student-friendly deep dive into this really crucial topic.
Yeah, that's the plan.
Think of it like your express lane to understanding how companies account for, well, all the different ways they put their money to work in the financial markets. We're going to try and break down the major concepts, the principles, the standards, show you exactly how they apply in, real-world financial reporting and decision-making.
Indeed. We'll be looking at everything from, say, how debt investments are classified and valued, right up to the different approaches for equity securities. And that depends a lot on the company's influence.
Influence, right.
Yeah, and we'll explore the implications of fair value measurement, how impairments are handled, maybe even touch on the fascinating world of derivatives. And crucially, we'll connect it all back to those foundational journal entries and how it shapes what you actually see on financial statements. What's really fascinating here, I think, is how subtle differences in maybe management's intent or just the level of influence can lead to completely different accounting treatments, even for things that look quite similar.
Right. So whether you're prepping for an exam, trying to make sense of a balance sheet, or maybe you're just, insanely curious about where companies put their cash, this deep dive is definitely for you. Okay, so before we get into the how, let's maybe tackle the why. Why is understanding a company's investments so critical for anyone looking at financial reports? Why does the accounting matter so much?
Well, if we connect this to the bigger picture, it really all boils down to capital allocation. Think about it. A healthy economy relies on an effective capital allocation process. It drives productivity, encourages innovation. Now, if financial information about investments is, say, unreliable or irrelevant, it distorts this whole process. It can adversely affect securities markets. So the information companies provide, when it's good, helps investors and creditors make informed decisions about where to put their own capital. It's not just about rules. It's fundamental to how markets work.
That's a really powerful idea. And we're not talking small change here, are we? Our source mentions Microsoft, for example. They had short-term and equity investments making up over 36% of their total assets on a recent balance sheet.
Exactly. Huge sums.
That's a massive portion of their whole financial picture. So what exactly are these securities we're diving into today? Can we just clarify the main types?
Sure. Broadly, we're looking at three major types. First, you've got bonds. Those are debt investments, basically lending money. Then there's stock equity investments, representing ownership in another company. And third, derivatives. These are financial instruments whose value is derived from other underlying assets, like a stock price or maybe an interest rate. And each of these is accounted for differently, mostly based on the investing company's intent or the level of influence they have over the company they invested in.
Okay, intent and influence. Got it. All right, let's unpack debt investments first. Bonds seem like a good starting point. The chapter says there are three distinct categories, and how a company classifies them really changes how they appear on the books. What are these three, and what makes a company choose one over the others?
Right. So we have held to maturity, often called HTM, then available for sale, or AFS, and finally, trading securities. The choice really comes down to management's intent. What do they plan to do with this bond? For held to maturity, a company must have both the positive intent and the ability to hold the bonds right until they mature. It's a strong statement.
So it's all about commitment. Like, we're in this for the long haul. And how are these HTM bonds recorded on the balance sheet?
Precisely. They are recorded at what we call amortized cost. Think of amortized cost as the bond's book value sort of gradually moving towards its maturity value over its life. If you bought it at a discount, the value creeps up. If you bought it at a premium, it creeps down. This adjustment slowly smooths out that initial price difference over time.
Okay.
And importantly, this means that daily fair value fluctuations, the market ups and downs, they aren't recognized on the financial statements. Not unless the bond is sold before maturity. But, this is a big but, if a company does sell an HTM bond before maturity, it can actually taint the entire HTM portfolio.
Taint. What does that mean?
It means they might be forced to reclassify all their remaining HTM bonds. It calls into question their original intent for holding any of them. We saw some of this during the COVID-19 pandemic, actually. Some banks needed liquidity unexpectedly, sold HTM bonds, and faced some pretty serious accounting consequences. So for HTM, the primary earnings are just the steady interest revenue they generate.
Wow, that taint effect sounds like a serious deterrent to selling early. Okay, so if the intent is definitely to hold and just collect interest, it's amortized cost. Simple enough. But what if a company wants more flexibility? What about available for sale securities? AFS, you call them.
Right, AFS. Available for sale securities are kind of a hybrid. They're debt investments that aren't classified as held to maturity or trading. Companies often use them for maybe potential capital gains or diversification, or just to keep some liquidity handy. It gives them the option to sell if market conditions look good or if they need cash.
Okay, so flexibility is key here. How does the accounting differ?
Here's where it gets really interesting. Unlike HTM, these are reported at their fair value on the balance sheet. So you see the current market price, but, and this is the crucial part, any unrealized holding gains or losses, meaning the paper gains or losses from market price changes that haven't been, locked in by
So
selling.
ones that haven't been cashed in yet.
Exactly. Those bypass net income. They don't affect the bottom line profit number directly. Instead, they go into something called other comprehensive income, or OCI. And OCI then accumulates in a separate section of stockholders' equity on the balance sheet.
Huh. So the company shows the up-to-date market value, which is good for transparency, but it doesn't make their reported net income bounce around all the time. That sounds like a pretty clever balance.
It is. It's a way to present a more complete picture of the asset's value without creating all that volatility in the main net income figure that investors watch so closely. Then, when a company eventually sells an AFS security, then the gain or loss is realized, it's taken out of that accumulated OCI bucket, and it's recognized directly in net income for that period.
Okay, that makes sense. It delays the income impact until the transaction actually happens. And finally, the third category, trading securities. What makes them different? What kind of strategy does this reflect?
Trading securities are basically at the opposite end of the spectrum, from held to maturity. These are bought and held specifically for short-term price differences. Think frequent buying and selling, may be held for less than 3 months, sometimes even days. The goal is quick profit from market moves.
So active speculation, really.
Pretty much. Like AFS, they are reported at fair value on the balance sheet. You see the current market price. But the key difference here is that they're unrealized gains and losses. Those paper gains and losses are recognized directly in net income as they happen.
So no OCI detour for trading securities.
Nope. Straight to the bottom line. This directly reflects their speculative short-term nature. If a company is actively trading to make quick profits, investors need to see those market swings hitting net income immediately to understand the risks and rewards of that strategy.
It's really fascinating how a company's intent, just what they plan to do, completely changes how the exact same bond might appear on their financial statements. Amortized cost, fair value through OCI, fair value through net income.
It really highlights the interpretive nature of accounting, doesn't it? And the importance of reading the notes to understand management's classifications.
Definitely. And you mentioned IFRS, the international standards. They have a similar structure for debt, right?
Yes, broadly similar. Under IFRS, debt investments are primarily classified based on a business model, basically,
Yeah.
held for collection, which is like HTM or trading. There's also a category that allows fair value through OCI, similar to AFS. The principles are aligned, even if the specific labels differ slightly.
Okay, good to know. Now let's pivot to the other big category, equity securities. Investing in other companies' stock. The chapter makes it really clear that your level of ownership, and therefore your influence over that other company, dictates the accounting method. What are these levels we need to think about?
Exactly. Influence is the key driver for equity. We generally look at three main levels: holdings of less than 20% ownership, holdings between 20% and 50%, and then holdings of more than 50%. Each level implies a different degree of influence over the investee's operations and financial policies, and so each triggers a different accounting method.
Okay, so let's start with the small stakes. Less than 20% ownership, that usually sounds like a passive interest, right? You're just investing for a return, not trying to run the show.
Correct. That's the general presumption. For holdings of less than 20%, where you don't have significant influence, the fair value method is generally used. Upon acquisition, you record them at cost. But after that, just like trading securities, any subsequent changes in fair value are recognized directly in net income. Realized gains or losses from sales also hit net income, and any dividends you receive, those are recognized as revenue.
Simple enough. Like owning a few shares of Apple, you track the market price changes in your income, and dividends are income too.
Pretty much. Think of someone like Warren Buffett's Berkshire Hathaway. They have a massive portfolio with many holdings like this. The rationale is, with such a small stake, you don't really influence the investee's operations, So their net income isn't really your income yet. You're just a passive investor looking for dividends and price appreciation.
Makes sense. But what happens when you own more? Say between 20% and 50% ownership. That sounds like you might start having a real say, even if you don't fully control the company.
Exactly. This is where we presume significant influence comes into play, and that leads us to the equity method of accounting. Owning 20% or more is the general guideline, but other factors can signal significant influence too, like having a seat on their board of directors or being involved in their policymaking. The source mentions Siemens and Areva as an example of this kind of relationship.
Okay, so the equity method. How does that work? Is it still fair value?
No, this is quite different. Under the equity method, your initial investment is recorded at cost, yes. But then you adjust the carrying amount of your investment up or down based on your proportionate share of the investee's net income or loss. So, if the company you invested in earns $1 million and you own 30%, your investment account goes up by $300,000, and you recognize that $300,000 as investment income.
Ah, so you're reflecting their performance directly in your investment's value?
Wow.
What about dividends then? Are they still revenue?
And here's the other critical difference. Dividends received under the equity method reduce the investment account. They are not recognized as revenue.
Wait, dividends reduce the investment? That feels backwards. Why?
It's a great question, and it catches a lot of people. But think about it logically. It avoids double counting. Under the equity method, you've already recognized your share of the investee's earnings as they occurred. Right, that increases your investment account.
Right, the $300,000 in my example.
Exactly. So when the investee pays you a dividend, they're essentially just distributing some of those earnings that you've already accounted for as yours. If you also recognize the dividend as revenue, you'd be counting the same economic gain twice, once when they earned it and again when they paid it out. So receiving the dividend is treated more like getting back a part of your investment, reducing its carrying amount. It reflects that the investee company now has less cash or retained earnings that belongs to you on paper.
Okay, that clicks now. Avoiding double counting. So the equity method really tries to reflect your ongoing stake in their underlying business performance.
Precisely. It gives a much better picture of your economic relationship when you have significant influence.
Got it. And then the final level, over 50% ownership. Now you're really calling the shots. Right.
Absolutely. Over 50% typically signifies a controlling interest. One corporation becomes a parent, and the other becomes a subsidiary. Now, while the parent company might still use the equity method on its own separate books just to track the investment, the primary financial reporting requirement here is consolidated financial statements.
Consolidation. I've heard that term. What does it involve?
It means you basically treat the parent and subsidiary as if they were a single economic entity. You combine their financial statements line by line, adding together revenues, expenses, assets, liabilities. You also have to eliminate any transactions between the parent and subsidiary so you don't inflate the numbers. It's a complex process, usually covered in more detail in advanced accounting courses. But the key takeaway is the goal: to present a true, unified economic picture of the entire group under the parent's control. Think of large groups like MGM Resorts International. With all its subsidiary casinos and properties, consolidation shows the whole picture.
Okay, so 3 levels for equity. Fair value for passive stakes, equity method for significant influence, and consolidation for control. That provides a clear framework. Now, beyond these core classifications for debt and equity, the chapter gets into some other really important reporting issues. Let's talk about the fair value option. What flexibility does that offer companies?
Ah, yes, the fair value option. This allows companies to irrevocably choose, meaning once they choose, they can't go back to report most financial assets and liabilities at fair value. The crucial difference is that all gains and losses related to changes in fair value, both unrealized and realized, are reported directly in net income. This applies even to instruments that would normally be accounted for differently, like held-to-maturity bonds or investments otherwise under the equity method, and it's applied on an instrument-by-instrument basis. So a company could pick one bond to use the fair value option for, but keep others as HTM.
So they could take an HTM bond, which normally doesn't show market fluctuations in income, and choose to have those fluctuations hit income. Why would they do that?
Well, proponents argue it provides more relevant and timely information about an asset's current value. Maybe it better reflects how they manage certain assets, or perhaps it helps offset the accounting impact of another instrument that is marked to fair value through net income, creating a sort of natural hedge on the income statement.
Well, it also sounds like it could lead to inconsistencies. Or maybe companies picking and choosing based on whether they expect gains or losses. Is there controversy around this option?
Absolutely. That's the main criticism. While it can improve relevance, it can also reduce comparability between companies if one uses the option and another doesn't for similar assets. And there are definitely concerns about potential gains trading or cherry-picking companies selectively applying the option to recognize gains in income while avoiding recognizing losses on other instruments by keeping them under different accounting methods. It's a definite point of debate in the accounting world.
Yeah, I can see that tension. Okay, what about when things go wrong? Impairment of value. What happens when an investment loses significant value and it looks like that loss might be permanent?
Right, impairment. The rules depend on the type of investment. For held-to-maturity debt securities, we now use the current expected credit loss model,
Okay.
often called CECL. This is similar to how companies estimate bad debts for their accounts receivable. It requires looking forward and estimating expected credit losses over the entire life of the bond, based on past experience, current conditions, and reasonable forecasts. It's a more proactive approach than waiting for a loss to be certain.
Okay, so CECL for HTM debt. What about available for sale debt investments? They're already marked to fair value through OCI, so how does impairment work there?
It's a bit different for AFS debt. If an AFS debt security's fair value drops below its amortized cost, a company needs to assess why. Is it just market fluctuation, or is there a genuine credit loss, meaning they don't expect to collect all the principal and interest owed? If they determine there is a credit loss and they don't intend to sell the security, and it's more likely than not they won't have to sell it before recovering the value, then they recognize an impairment loss. However, the amount of loss recognized in net income is limited. It's capped at the amount of the credit loss itself or the difference between amortized cost and fair value, whichever is smaller. This is sometimes called the fair value floor. Any additional decline in fair value beyond the credit loss continues to be reported in OCI.
So there's a limit on how much hits net income for AFS impairment related to the actual credit deterioration.
Exactly. It tries to separate the credit loss component, which hits net income, from the general market value fluctuations, which mostly stay in OCI unless it's a credit loss. For equity investments accounted for under the fair value method, like passive stakes or trading securities, impairment is effectively handled automatically through the regular fair value adjustments that already flow through net income.
Got it. And how does all this, especially OCI stuff for AFS securities, tie into the bigger picture of comprehensive income on the financial statements?
Right. Comprehensive income. It's a really important concept. It's designed to give a more, well, comprehensive picture of a company's overall change in equity during a period from non-owner sources. It includes the standard debt income that everyone focuses on, plus other comprehensive income, OCI. OCI is the holding tank, remember, for those unrealized gains and losses from available for sale securities, and also certain gains and losses from derivative hedges, which we might get to.
So it adds back those things that bypass the main income statement.
Precisely. It shows the full impact of all economic gains and losses for the period, even those not yet realized through transactions. Companies can present this in a single continuous statement of comprehensive income, or in two separate statements, a traditional income statement followed by a statement of comprehensive income. The items in OCI then accumulate over time on the balance sheet in a separate component of equity called accumulated other comprehensive income, or AOCI. And one final point here, when an AFS security is eventually sold, you need what's called a reclassification adjustment. You have to move the gain or loss out of AOCI and into net income to avoid counting it twice in comprehensive income over the life of the investment.
Okay, that makes sense. It keeps the overall picture clean. Phew, that's a lot on debt and equity. Should we dare to venture into derivatives? They always seem like the really complex part of finance and accounting.
Huh. They can be, but let's break it down. Derivatives are essentially financial contracts whose value is derived from an underlying item. That underlying could be anything: a stock price, an interest rate, a commodity price like oil or corn, even the weather. Key features are that they usually involve little or no initial net investment compared to buying the underlying asset directly, and they often allow for net settlement, meaning you just pay or receive the difference in value rather than exchanging the whole underlying asset.
And why do companies use these often complex instruments?
Primarily for two reasons. Risk management, which we call hedging. That's using a derivative to offset potential losses from fluctuations in prices or rates. Think of an airline hedging jet fuel prices. The other reason is speculation, basically, making a bet on which way prices or rates will move, trying to profit from those movements without necessarily owning the underlying asset. The source mentioned examples like Dell may be using Google stock options, or an agricultural company like Heartland Ag hedging potato prices. Common types you hear about are forwards, futures, options, calls and puts, and swaps.
Okay, hedging to reduce risk, speculation to seek profit. How does the accounting differ between those two uses?
Big difference. If a derivative is used for speculation, the accounting is pretty straightforward, similar to trading securities. You recognize the derivative as an asset or liability on the balance sheet at its fair value.
Hmm.
And any changes in that fair value, the gains or losses, hit net income immediately, period by period, reflects the speculative nature.
Makes sense. High risk, immediate income impact. What if it's used for hedging?
Now if it qualifies for hedge accounting, the rules change dramatically. The whole goal of hedge accounting is to match the timing of the derivative's gains or losses with the timing of the gains or losses on the item being hedged. This way, the financial statements reflect the economic substance of the hedging strategy, which is usually to reduce volatility. Without special hedge accounting, you could have the derivative gain-loss hitting income in one period and the hedged item's loss-gain hitting in another, making income look more volatile, not less.
So hedge accounting tries to sync things up. What are the main types of hedges?
There are two main types we need to know: fair value hedges and cash flow hedges. A fair value hedge is used to offset the risk of changes in the fair value of an existing asset or liability or an unrecognized firm commitment. Think about hedging the value of inventory you hold or hedging fixed-rate debt against changes in interest rates. With a fair value hedge, the magic is that both the gain or loss on the derivative and the offsetting gain or loss on the hedged item, due to the risk being hedged, are recognized in net income in the same period.
So if they perfectly offset, the net impact on income is zero.
Ideally, yes. If the hedge is effective, a loss on your inventory due to falling prices would be offset by a gain on your derivative hedge, like a put option, and both hit income together, smoothing out the result. The source had an example with Hayward Tire Fabricators hedging tire inventory.
Okay, that makes intuitive sense, reflecting the offset in income. What about the other type, cash flow hedges?
A cash flow hedge is used to offset the risk of variability in future cash flows. Think about hedging a forecasted transaction, like a planned purchase of raw materials in a foreign currency, or hedging variable rate debt payments. Here, the accounting is different. The effective portion of the gain or loss on the derivative is initially recognized in ability. Other comprehensive income, OCI, remember our friend OCI?
Back to OCI again.
Exactly. It stays parked in OCI, accumulating in AOCI on the balance sheet until the period when the hedge transaction actually affects earnings. So, for example, if Allied Can Co. hedges a future purchase of aluminum, the gain or loss on their futures contract goes to OCI initially. Then, when they buy the aluminum and later sell the cans made from it, affecting cost of goods sold, that's when they reclassify the derivative gain or loss from OCI into earnings, matching it with the cost of the hedged inventory.
So fair value hedges impact net income immediately, both sides, while cash flow hedges delay the derivative's income impact via OCI until the underlying cash flow occurs.
You got it. That's the core distinction.
And just to add one more layer of complexity, the chapter mentioned embedded derivatives. What are those?
Yeah, sometimes you have hybrid securities. A classic example is a convertible bond. It's a bond, but it has an option embedded within it, allowing the holder to convert it into stock. Accounting rules require that sometimes companies have to separate the term, is bifurcate this embedded derivative component from the host contract, the bond itself. Then they account for that embedded derivative separately at fair value, with gains and losses typically going to net income, just like a standalone derivative used for speculation. The host contract, the bond, continues to be accounted for based on its nature.
Why the separation?
It's mainly for consistency and transparency. It ensures that derivatives with similar economic characteristics are accounted for similarly, whether they stand alone or are embedded inside another instrument. It prevents companies from hiding derivative features inside other contracts to avoid fair value accounting. Of course, there are specific criteria for when bifurcation is required and rules around qualifying for hedge accounting like documentation and effectiveness testing.
Okay, derivatives are definitely complex, but that breakdown helps a lot. Fair value seems to be a recurring theme here. With all these different ways to measure and report things, especially using fair value, transparency in the disclosures must be incredibly important, right?
Absolutely critical. Investors need to understand how companies are arriving at these fair values. That's why companies have to provide detailed disclosures about their financial instruments. They generally need to disclose both the cost basis and the fair value for most financial instruments in the notes to the financial statements. And crucially, They had to disclose the inputs used for the fair value measurements using the fair value hierarchy.
The hierarchy. Levels 1, 2, and 3. Can you remind us what those mean?
Sure, think of it as a ranking of reliability for the fair value inputs. Level 1 inputs are the most reliable. Quoted prices in active markets for identical assets or liabilities. Think of a stock price on the New York Stock Exchange. Observable, verifiable, identical. Gold standard. Level 2 inputs are observable, but not for identical items. They might be quoted prices for similar assets in active markets, or prices for identical assets in markets that aren't active, or inputs other than quoted prices that are observable, like interest rates or yield curves. Requires some adjustment or comparison. Still pretty reliable. Level 3 inputs are the least reliable. These are unobservable inputs. They reflect the company's own assumptions about what market participants would use. This requires significant judgment and modeling. Think of valuing a unique private company investment or a complex derivative with no market data.
So, as someone reading the financial statements, you'd pay close attention to how much of a company's fair value measurements rely on those level 3 inputs because they involve the most estimation.
Yeah, exactly. Significant level 3 assets or liabilities warrant more scrutiny, and companies have to provide extra disclosures about them, including a reconciliation showing how those level 3 fair values change during the period. It helps users gauge the reliability of the reported fair values.
Okay. So, bringing this all together, we've covered debt classifications, equity methods based on influence, fair value options, impairments, derivatives, hedging, disclosures. What's the big picture takeaway for us as learners trying to make sense of all this when we look at a company's financial statements?
Well, I think it really raises an important question for critical thinking, doesn't it? When you realize that the exact same debt security could potentially be classified and reported in three different ways: amortized cost, HTM, fair value through OCI, AFS, or fair value through net income, trading or fair value option, based solely on management's stated intent.
Yeah.
What does that really tell you?
Yeah, it suggests there's a lot of judgment involved.
A huge amount. It highlights the potential for subjectivity in financial reporting and raises questions about comparability between companies. Are they choosing the classification that best reflects the economics, or the one that gives the most favorable accounting result for that period? It really encourages you, as a user of financial statements, to look beyond just the numbers on the face of the statements, dig into the notes, understand the classifications and assumptions, and think critically about the story that management is trying to tell. Is it the complete and unbiased picture?
That's a fantastic point to end on. Look beyond the numbers, understand the intent and the methods. And that pretty much wraps up our deep dive into investments in intermediate accounting. Wow, we covered a lot of ground classifications, methods, journal entries, OCI, fair value, derivatives, hopefully making these complex topics feel a little less daunting.
Yeah, hopefully. Remember, the goal here is about gaining that knowledge quickly but thoroughly, seeing the different angles and maybe having a few aha moments along the way. We really hope this has given you a solid foundation for understanding how companies strategically manage and, importantly, report their investment portfolios.
We definitely encourage you to go back to your sources, re-examine those examples in KISO or wherever you're studying from, and just let these concepts sink in. Like anything complex, the more you engage with the material, the clearer it starts to become.
Absolutely. From the Last Minute Lecture team, thank you so much for joining us on this deep dive into the fascinating and sometimes tricky world of accounting for investments. Keep learning, keep asking questions, and stay curious.